Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. I'm glad to be with you this morning. Just wanted to spend a couple of minutes talking about this last week in the markets. And as many of you know, most eyes in the financial world were on the Federal Open Market Committee meeting, or the Fed meeting this last week. The meeting took place on Wednesday. What came out of that meeting is the Fed has decided for now that they're not going to raise interest rates. But it did sound like they were going to raise rates another quarter point by the end of the year. We don't know when that's going to happen, but it sounds like that's kind of already built into their plans. As of right now, the current rates are 5.25 to 5.5. They also signaled that there would probably be some type of an interest rate uh, drop next year of 0.5%. We don't know when that's going to be. We'll continue to watch that very closely. After the meeting, as they were taking questions, they pointed to the solid pace of the economy, economic growth, as to why they decided what they were going to do. So we're going to continue to monitor that. Again, in 2024, we're hoping to see the first interest rate drop that we've seen in a while. Um, what does that mean? A chart I wanted to share with you. This is the average S&P dispersion relative to interest rates. And basically what that means is it's a chart, as you can see down here in the left-hand corner, as interest rates go up, typically what happens is the dispersion rate or the volatility of stocks in the S&P 500 go up. What that means to us is in the situation that we're in with elevated interest rates, we think that we're going to continue to see a little bit more volatility. Like what we've seen over the last 4 or 5 months, we see that continuing on into the near future. And like I said, we're going to watch interest rates very, very closely, and we'll have more updates on that as we get more information. A couple of sectors that I wanted to maybe highlight. The energy sector has actually done very, very well over the last few months as oil prices have gone up. That is one sector that has done well. Another sector, and we talked about this a couple of weeks ago, is the tech sector. Just for fun, I looked up this morning. It seems like Nvidia has kind of been the darling of the markets over the last 3 or 4 months, and there's been a lot of growth. In fact, a lot of the growth has been just at the very top of the S&P 500. There's 8 or 10 companies that have had most of the growth, Nvidia being one of those. So as I looked at this, I looked up the PE ratio of Nvidia. What is Nvidia? Is it fairly priced? Is it overpriced? Is it underpriced? And we look at PE ratios, price to earnings ratio. What is the price of the stock in the market relative to its earnings? And the PE ratio is for every dollar of earnings that a company has, what does that equate to in the value of the company? We like to see companies anywhere from 20 to 25, we think is a fair valuation. So for every dollar of earning the company has, 20 to $25 is what that dollar of earnings will sell for in the market. Nvidia is currently at 99. Now they're an outlier, but what that shows is a lot of the tech sector is overvalued, especially in the AI-driven rally that we've seen over the last couple of months. So with higher interest rates, we see those companies, the valuation starting to come down just a little bit. A couple other sectors that we look at, materials, industrials, manufacturing, healthcare, utilities, real estate. Those are all struggling due to elevated labor cost and higher interest rates. Obviously, all of those sectors are very closely aligned to interest rates and the cost of labor. So, in a nutshell, what we see coming down the road is more volatility. What we think needs to happen is we need to continue to find good quality companies, have good, solid, diversified portfolios, and know that we are going to have a little bit more volatility, but we think that the markets will continue to perform. And as interest rates come down, we think that there will be good growth opportunities, hopefully in 2024, as we see some relief from these high interest rates. Anyway, grateful that you're with us. Please don't hesitate to share this with friends or family. And if you have any questions, please get a hold of us. We'd be happy to take any questions offline. Thank you. Bye.